Imagine spending a decade building your company. You're finally at the table, and the buyer slides over a signed offer for $12 million. It's easy to focus on that top-line number and start mentally spending the money, while your broker promises they've secured you top dollar. This shows the gap between the offer and the reality of an exit. We start with a $12 million gross amount. Immediately, the IRS and California Franchise Tax Board take deductions. Then, ordinary income penalties trigger, leaving a much smaller net proceeds bar. Most brokers will push you to accept this quickly. They want to lock in the buyer and keep the momentum of the deal moving forward. You'll often hear the advice to sign now to secure the price. Then have your CPA review the specific details during the escrow period. But celebrating a gross offer before calculating tax liabilities leaves you vulnerable to severe wealth erosion. You only win the exit if you keep the proceeds. This makes the letter of intent the most critical document in the entire negotiation. Founders often view the LOI as a non-binding handshake, a simple agreement on the purchase price. In practice, the LOI serves as the structural blueprint that locks in the deal mechanics that will dictate your final tax bill. While you focus on the price, sophisticated buyers use the LOI to shape the terms and risk allocations in their own favor. Even when terms are labeled non-binding, deal momentum creates a practical obligation. Once terms are on paper, they are very difficult to reverse during due diligence. If you accept a specific structure, like an asset sale, or a specific allocation now, you lose the ability to negotiate those points from scratch later. Waiting until escrow to address tax strategy means you've already surrendered your leverage to the buyer. This matrix shows the first major conflict point, the sales structure. You choose between an asset sale and a stock sale. Buyers demand an asset sale to step up asset basis and limit exposure to historical risks. However, certain C-corps may qualify for qualified small business stock. This shield can eliminate millions in federal capital gains taxes. But accepting a buyer's default asset sale structure immediately disqualifies you from using this QSBS shield. Securing a stock sale requires a trade-off. You have to find ways to bridge the buyer's risk concerns to keep the deal on track. Experienced advisors often use reps and warranties insurance to cover those risks, allowing the seller to maintain the tax-efficient stock structure. Passively accepting the buyer's preferred framework can cost you millions in legal tax protections, just to avoid friction early in the deal. The second battleground is purchase price allocation. This scale represents how the IRS views your proceeds. Buyers want the price allocated right toward equipment to depreciate it quickly. But you need value allocated left toward goodwill to capture lower long-term capital gains rates. Negotiating this language into the LOI requires a direct challenge to the buyer's financial model right at the start. If you concede this allocation early, you are essentially agreeing to pay a higher tax rate on your own proceeds. Finally, we have earnouts, future payments depending on how the business performs after the sale. But buyers often leave these payment triggers intentionally vague. This creates a significant risk. The IRS or state tax boards can reclassify vague earnouts as compensation for future services instead of sale proceeds. Preventing this reclassification requires precise legal drafting before the LOI is signed, which can feel like it's slowing the process down. Without that specific language, your expected windfall could be taxed at standard, high-level wage rates. Navigating these three battlegrounds effectively depends entirely on the team you have behind you. A standard broker model focuses on matchmaking, finding the buyer and the price, then hoping a CPA can fix the tax issues once the deal is already structured. An integrated M&A advisor functions as a quarterback, designing the tax architecture at the table before any signatures are exchanged. Professional buyers, especially private equity firms, never negotiate alone. They show up with teams of attorneys specifically hired to lower their cost basis at your expense. Facing a private equity team with only a standard matchmaker broker often results in being structurally outgunned. This quadrant helps you decide if hiring specialized tax counsel before the LOI is worth the investment. In the bottom left, we have low-complexity, asset-heavy Main Street businesses, like a single-location restaurant. For these businesses, an asset sale is generally the only path, so the return on complex tax engineering is usually minimal. But in the top right, we have high-value, IP-driven businesses, or C Corps, held for more than 5 years. For these founders, an M&A tax attorney is the primary defense mechanism required to protect the payout. Audit your deal team's tax expertise before the LOI lands on your desk. A top dollar price only matters if you keep it, and you keep it by engineering the tax strategy before you sign.